So yesterday I did a Zoom call with a gentleman, a very senior person in the information technology industry. He has a decent size portfolio and he wanted to talk to me. He wanted to know what is my trading style, what services do I offer, what is the difference between my video course, training, coaching. So he just wanted some guidance. So we were having a discussion and he asked me one question. Okay. And that question you might have in your mind as well. The question is, Rohit, which stock should I hold on to in my portfolio and which stock should I sell for a quick profit? Okay, very important question. If I got two stocks in my portfolio, I want to decide which one of them should I hold on to for the long term and which one should I sell for a quick profit. So if you have been studying from my YouTube channel, you already know the difference between swing trading or swing trading and positional trading. You also know what is the criteria to be used to identify stocks for swing trading. You know the criteria to be used to identify stocks for positional trading. The fundamental difference is in swing trading, you are looking for quick double digit return in a few weeks. So if I am getting a double digit return in 2 to 4 weeks, fantastic. I am out of the stock. I will book my profit, sell all my shares, and use that profit to finance the risk on my next trade. In swing trading, the risk is higher. And in swing trading, we only look at relative strength and technical strength. In positional trading, we look at relative strength, we look at technical strength, and we look at fundamental strength. Sales, earnings, margins, return on equity. We look at these four additional factors because those factors will give us the confidence to stay in the stock for a long period of time. And in this video, I want to show you two examples. Assume that you have these two stocks and you bought them at a specific point, which I will show you in this video. And we will see whether it was worth selling or whether it was worth more holding the stock. Okay. Let's start with the first example. I think the example is the best way to understand. So let me open a stock for you. So remember, I had bought this stock, Chennai Petro. I had made a video on this. Okay. So this is the base. So let me hide all this. Yeah. See, this is the base. Blue, green, red. The price is above the 50-day moving average. The 50-day moving average is above the 150-day moving average. And the 150-day moving average is above the 200-day simple moving average. Okay. Basic stage 2 uptrending stock. Step 1 is a high volume rally. Step 2 is a low volume consolidation. Step 3 is a high volume breakout. Okay. So here we are expecting a breakout. There are easily more than 10 candles in the base. There are 4 points in the base. Plus there is mother baby candle. This much you already know. Okay. If you want me to draw, let me draw the number of points for you. 1, 2, 3, 4. Okay. Perfect setup. And moreover, the buy point, which is the yellow line, is in the green zone, which is fantastic. Okay. So blue, green, red, 10 candles, 4 points. Very simple formula. Okay. Which I use personally. This helps me identify a proper base. So I buy the stock the next day as it breaks out. Okay. Breaks out on high volume, closes above the yellow line. You get price confirmation, you get volume confirmation. And then look what happens next day. It shoots up 12%. And I end up selling somewhere here, booking kind of 16 to 17% profit just in a couple of days. Okay. Now the question is, obviously, this is a swing trade because I sold in 2 days. So if I'm getting a double digit return in 2 days, which I am expecting in 2 to 4 weeks, obviously I'm going to sell all my shares. So that was the primary reason why I sold out. Now, why do I categorize this stock as a swing trade position? Why not hold this stock for the long term? Okay. And my decision to sell here was precise. If you see what happened in the next 2 days, it completely collapsed. So if I had held on to the stock for just 2 days, instead of making 16, 17%, I would have lost 2, 3%. Okay. So decision to sell here was extremely important, and this shows us the importance of timing. Okay, timing is extremely important. If I am getting a nice double digit return in just a couple of days and the stock does not show fundamental strength, obviously it's a swing trading position, I have to sell. So before even I buy a stock, I have already built my expectations regarding the stock. And if the stock meets that expectation, I will sell and I will get out. So let me explain. So I buy here. Look at the buying date, 15th of July. Now, every quarter, the results are announced, right? So 15 July means probably by that time, the quarterly result was announced. Maybe I was looking at the quarterly numbers at that time. Okay. I don't exactly remember what exactly, whether the results are announced or not, but let us have a look at Market Smith, whether those results are there or not. Obviously, those results are going to be there because we are in October right now. As I record this, it's October. Let me open the. See, in June, the quarter ends. And by 15th of July, in 15 days, companies release their quarterly results. Okay. So see, June quarter, minus 36%. And even before that, now I don't precisely remember whether I was looking at the June quarter or the March quarter, but I did keep an eye on what is happening here. So see, last two quarter, March minus 38% EPS growth, June minus 36. So if this was not released on the breakout day, okay, then I was looking at this number. Okay, because this number obviously is going to be there. Okay, neither of the numbers tells you that this is going to be a positional trade, right? So I don't precisely remember which because the numbers are also very similar, so I got confused. But anyways, if I was not looking at this number, if it was not published by that time, at least this number was there for me to see, which is a clear sign that this is not a positional trade. Because in positional trade, I am looking for fundamental strength as well. Okay, so since this is a swing trade and I'm expecting a nice double digit return in 2 to 4 weeks, and I'm getting that result in 2 days, that is why I sold the stock. So now you understand how I decided that Chennai Petro is a stock which I don't want to hold on for the long term. I want to sell it for a quick profit now. Okay. This is one example. Second example I would like to give you is Cochin Shipyard. Recently, the shipping companies were doing very well. So if you look at this base, let me, you look at this base, nice tight price action. Okay. Blue, green, red, more than 10 candles in the base, 4 points in the base, nice tight price action on the right side, and mother baby candle. So all four conditions. Basically, there are three conditions: blue, green, red, 10 candles, 4 points. Okay, in the base. Mother baby candle is an additional, kicker. So you go from here to here, 3, 4 points in the base, an extremely tight base. This is a no brainer. Okay. So this. So I put the yellow line at the high of this candle, which is 1370. Sorry, 1370. Okay. And look what happens the next day, breaks out 5% up, high volume. Okay. So volume confirmation, price confirmation. Remember, I have been repeatedly telling you that this yellow line represents your opinion. It does not represent a fact. Your opinion needs to be confirmed by the market. How does the market confirm your opinion? It will give you price confirmation by closing above the yellow line, and it will give you yellow confirmation by closing above the blue line. Okay. Unless you get price and volume confirmation, don't get involved. Okay. And then look what happens. It goes up from here. See, this is that candle, the breakout candle looks so tiny. It goes up and finally it closes below the blue line here. So 2291, and this is 1370. Okay, so from 1370 to 2291, so around 60-70% return. Let's look at that. So here, 65% return. Okay, 66% return. So this is the candle when the price closes below the 50-day simple moving average. Remember what I told about positional trading? You buy a stock and then you hold on to the stock till it breaks the blue line, which is the 50-day simple moving average. You could also choose to use the purple line, which is the 21-day exponential moving average. See, this is the exponential, this is the simple moving average. So the price breaks the 21-day exponential on this day. This is not much of a close. If you see the closing price, this is 1684.55, and the exponential moving average is 1683 if you check here. So this is not a close below the 21-day. This candle closes below the 21-day. So you could use either of the moving averages, okay, to control, to manage that trade. Now, important thing, look at the date of purchase, 17th of May, which means what? This came after March quarter. So March, the quarter ends, then after March, there is June. So March 2024 result has to be there, the quarterly. So let's look at March 2024 result for Cochin Shipyard. Go to Cochin Shipyard. You click on consolidated. See March 2024 triple digit return in quarterly EPS, triple digit growth in quarterly EPS number, triple digit growth in sales for that particular quarter. This is excellent fundamentals, okay? Which is the reason why the stock ran up how many percent? See, from here to the top, it shot up 117%, which corresponds to this sales growth, explosive sales growth, and explosive earnings growth on a quarterly basis. Okay, so you see the past 3 quarters, you have accelerating growth in quarterly EPS. Okay, past 3 quarters, you have accelerating explosive quarterly growth in sales numbers. This number was not there at the time of buying the stock. So you are looking at excellent fundamentals. So the stock ends up going 100% in just a matter of 1 or 2 months. But then it starts to fall. See, from July till here, it has only been falling. Why do you think that is? Look at the earnings, latest earnings, minus 12% quarterly growth in EPS. So whenever the EPS growth rate quarterly is accelerating, the stock is going to go up. Whenever the quarterly EPS growth rate is decelerating, as we saw in Chennai Petro, the stock is going to show weakness. So, can you clearly see the correlation between the improving fundamentals and the rapid growth in price of a stock, and declining fundamentals and rapid decline in the price of the stock? So the stock follows fundamentals on the longer term. So quarterly, annually, the stock will follow the fundamentals, especially quarterly sales growth and quarterly earnings growth. Okay, very important. So positional trade. So you don't have to wait. So when June quarter result comes, the moment the June quarter results are announced, okay, you should start probably cutting down your position, because by the time you are in the by the time the quarter ends, the stock has already shot up a lot in a month. Okay, so here you should be selling somewhere here. So you should be booking around 70 to 80% profit in that particular area. So this is an example of a positional trade. Okay, you hold on to the stock because it is showing good fundamentals. Suddenly, if the fundamentals deteriorate, if it drops from plus 200% growth to minus 12% growth, that's a sudden shift. I mean, something has gone wrong with the company. So if you don't want to sell all your shares, at least sell half, right? So now you understand. This is almost like a positional trade, because you're from May till August, you are holding on to the stock. So it's not that you're holding it for 5 years or 2 years or 10 years. It's a small period, but from a trading perspective, it's a long time, from May, June, July, August, it's almost like holding an investment stock. Okay. But you are looking at the moving averages. So now you understand what to look for to decide whether you should hold on to a stock or whether you should sell a stock if it is giving you that quick profit burst. Okay. So please understand the difference between swing trading and positional trading. Just to summarize, for swing trading, we look at relative strength and technical strength. For positional trading, we look at relative strength, technical strength, and fundamental strength. For swing trading, you are expecting a double digit return in 2 to 4 weeks. For positional trading, you are hoping to be in the stock as long as it remains above the blue line, which is the 50-day simple moving average. And you're hoping that the fundamentals during that period do not deteriorate. And if they are deteriorating, there is a case to be made to reduce the position in the stock and move that money to some other stock. So that's if you understand the difference between swing trading and positional trading, you will know what to do. You will know which stocks to hold on to, which stocks to sell. Okay. So I hope this video added value to your trading journey. Please like, share, and comment on this video so that this video gets that reach, so that this video reaches those people who genuinely want to become professional stock traders. And your support is important for this YouTube channel. Unless you support this YouTube channel, it will not get the reach that it deserves. A lot of students have come back to me. I get an email almost every day saying that your content is helping us. So please share this video. Please help this YouTube channel grow. Without you, this YouTube channel cannot grow. Okay. So thank you so much for your time. Thank you so much for your effort. If you have any doubts, write to me, email me, talk to me, but don't get stuck on any concept. Okay. Clear the concept fast and grow in your trading journey. Thank you so much.